Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I'll be your host today. And I'm really excited to have Michael Ervolina with us today. Michael is the founder and principal of ErvoSquare. He's acquired over $30 million in assets under management in the last 3 to 4 years in small bay industrial and industrial with outdoor storage. So, Michael, welcome to the show. Excited to jump into this new asset class for our podcast. Welcome.
Thanks for having me, Randy.
Awesome, Michael. Well, let's jump right in. Tell the audience, if you can, a little bit more about yourself and how you found yourself here in Colorado doing what you do today.
Sure. Well, anybody who knows me knows I was born and raised in Buffalo, New York. That's a big part of me and who I am, and Bills Mafia faithful. But after high school, I moved to Villanova University, where I played club ice hockey and majored in finance and business. So, but there was one class that stuck out for me during that time, and that was my minor in entrepreneurship. It was something that I was just fascinated with and loved the idea of starting and creating your own business. So that's something that never left me from my time in school. But as you know, after school, I graduated in 2008. That's the great financial crisis. I went straight to New York City, where I got a job on Wall Street. Every person in finance's dream. But worked for a small company called JP Morgan for about 5-6 years. I was in the sales and trading business there. Worked in New York, even had a brief stint in the Tokyo office. So that was great. But deep down inside, I just continued to have this entrepreneurial itch and just the need to do a little bit more than banking or working in corporate America. So around that time, I thought about getting involved in commercial real estate. So my brother was in the business at the time. My father's in the hardware business, owns some real estate for that business as well. So I wanted to transition from finance, Wall Street, to real estate, but it was a harder transition than I thought it would be. I was, I think, 28, 29 at the time, and a lot of companies didn't want to take a chance on someone, I guess, older, you could say.
Sure.
So around that time, I got a master's in real estate from NYU's Shack Institute of Real Estate. So that's a great master's program based in New York City. And around that time as well, I finally got an opportunity, but it was an unpaid internship, but it was at one of the best capital markets companies, real estate investment banking companies in New York. And at that time, I said, hey, this is a good opportunity to get my foot in the door, learn from some of the best in the industry. So that's what I did. I took that unpaid internship.
Was that Walker and Dunlop or?
Well, funny you have it. I actually took a paid job there, and then took a step back to get to be in the analyst program at a company called Ackman Ziff, which is one of the best boutique capital advisory firms in the country.
Yeah, fantastic. So I'm a big fan of Walker and Dunlop has Walker Webcast podcast, which I listen to every week, which is just amazing. And then to see the Ziff name as well. I think he's authored a few books as well, right?
Yeah, he's Simon. He's a big LinkedIn presence, so you'll see him on there just sharing his knowledge. So he's a well-known guy in the industry, and learned a ton there. I mean, I was looking, in my opinion, real estate's a long-term game. So if you have to pay your dues for a couple months, a year, whatever it is, it's just learning the business, learning the fundamentals, really building relationships. And that's what I did there. But always wanted to be on the investment side and the operating side of the business. So when I graduated from NYU about 2 years later, I got a job at a small investment company, private equity company in New York City. We were buying distressed real estate all across the country. But that's where I really cut my teeth in the business, hopping on a plane every other week to places like Baton Rouge or St. Louis or Baltimore, finding these distressed real estate opportunities and buying them.
Yeah.
So that
What
was a
timeline was this? What year was that?
this was probably, let's see, 2017 to 2020.
Okay.
So we were buying a lot of non-performing loans, REOs out of CMBS trusts,
Okay.
a lot of stuff that was being worked out 10 years after being originated. So that was where I really learned the business from soup to nuts, cradle to grave, how to underwrite, how to do diligence, how to raise capital, how to close the acquisition, how to manage and execute your business plan, how to
Wow.
negotiate leases, manage development projects, and how to sell it. So had a lot of success and got a lot of great experience there. I probably learned 10 years worth of real estate in, the 3, 4 years I was there. But 2020 came around. I was in New York City for 12 or 13 years at the time and kind of looking for a change of pace. Wife, who was the girlfriend at the time, we're thinking about moving to a new city. So early 2020, packed up after 12 years in New York and moved to Denver, Colorado, which is where I am now. And looking back at it, it's just trying to look for my next move. But I had a couple interviews with small investment companies, but I kind of pinched myself and I said, Mike, now's your time to act on that
Yep.
entrepreneurial itch, that entrepreneurial dream. If not now, when? So in June of 2020 is when I launched ErvoSquare, which is my company now. And 4 years later, we're still going strong. We're just had our first hire, just leased some office space, and we're really trying to double down on our strategy. But yeah, everything's going great. But looking back at it, new city, the depths of COVID, I really had no personal network, no business network. Maybe not the best time to start a business, but
Yeah.
there's no time like the present. So
I agree. I
happy
agree.
we did.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Yeah, well, congratulations. What a ride. Spending 12 years in New York for one. I'm jealous. I've always had a desire to spend maybe just a year in New York, living in the city. I just love the city myself.
Yeah.
But working for one of the big banks and then going down and going back for your master's at that point, that's fantastic. And then really kind of cutting your teeth with some of the big names in the space. That's fantastic that you got an opportunity to spend those 3 years there. So now, when you were in that space, did you have a number of different roles when you were with that commercial real estate firm, or were you an analyst primarily, or what were your roles and responsibilities? It sounded like you got involved with a lot of different things, but just curious what that looked like.
Yeah, so on the investment side, we were a very flat organization. So you pretty much were involved in all facets of the business. I'm a big believer that, you can't just be an acquisitions guy or an asset management guy. To really understand the business. You need to pretty much do everything because the deal doesn't stop when you close. In fact, that's when it just starts. You have
Yeah.
to, execute your business plan and your underwriting, what you pitch to the investors. So yeah, these investment companies, I had experience everything from the start to the beginning, and that's where I really understood the life cycle of an investment. That's where I really understood how to underwrite something because the real world is a little bit different than what you project in Microsoft Excel.
Of
So
course.
it was a little bit of a sink or swim type of role. It's a meritocracy. You do well, you kick butt, you're going to be rewarded for that. So we really worked hard, and like I said, I probably had 10 years of experience there, in just a couple of years at those companies.
I'm always fascinated with folks. And it's funny, I worked for a large Fortune 100 bank for a number of years, and I got to interview entrepreneurs. And one question I'd always ask is, like, let's dig into that moment where you're in New York, you're making the decision about this big move, and the thought of chasing another corporate America or W-2 job or jumping into entrepreneurship? Like, what did that period look like? Did you guys move to Colorado because you had family that was there, or was it like a strategic decision to move there because of the market, or what were driving those decisions?
So it was mostly a change of lifestyle that we were looking for when we moved from New York City to Colorado. But I like to ski, I like to golf. Those types of things are a little bit tougher when you don't own a car and you're living in Manhattan. And now I'm blessed to golf or ski 20 plus days a year, and get out and golf as much as I can. But like the icing on the cake is Denver's a growing market. It's a great business community, and it's really been supportive of ErvoSquare and my dream and efforts to be an entrepreneur. There's a lot of people like me from Chicago or San Fran or New York or wherever who've moved to Colorado to do the same thing as me. So just having that business community here and just experiencing the growth, which is also good for real estate, obviously. That was just kind of icing on the cake when I started my job here.
So, all right. So you had exposure I'm guessing, a number of different asset classes with those organizations. You chose to really hone in and focus on industrial, and then industrial IOS. Can you tell the audience what that is?
Yeah, so I'm a value add industrial investor. So just looking for underperforming industrial assets. It's not the sexiest or most attractive asset class. But in my opinion, it's the most fundamentally strong and has the most limited downside of, retail, office, multifamily. So we could get into that. But in terms of industrial with outdoor storage, which is one of my focuses within industrial, it's a warehouse with a couple acres of, fenced in storage yard. For example, call it a 15,000 square foot shop building with 5-6 acres of fenced in storage yard. It could be gravel, it could be paved. And these are attractive for companies that, have a truck fleet that they need to park hundreds of cars. Maybe they have a bunch of materials, maybe they have a bunch of equipment, and it's just cheaper to store that equipment and things outside than it is underneath a roof. So when there's a warehouse with this outdoor storage component, that's just really attractive for these types of tenants. And there's a big supply and demand imbalance. Municipalities don't like this type of product because if you're driving by it, it looks like a truck parking yard. It looks like a scrap yard. It's just not an attractive thing to look at. They'd rather have, a shiny new retail center or something else. And then also it just doesn't garner a lot of tax. Land is typically taxed less than something that's improved. So a lot of these municipalities are trying to move away from this industrial outdoor storage asset class, but there's still a big need for it. And it just keeps getting pushed out from central locations within around these big cities, but it's a big need and it's going nowhere.
Interesting. So it's permitted differently than just traditional industrial or some of the other similar type of asset classes?
Yeah, and that's where kind of it gets complicated because each municipality has its own zoning and code ordinances, and some you could do this here but not there, and some when they update the code to current standards, maybe they allowed outdoor storage in the past but they don't anymore. If it's a separate parcel but the same owner, you can't store on that additional parcel. There's all these different rules depending on the jurisdictions. And in some jurisdictions, don't go there if you're trying to do outdoor storage, because even if it's zoned, they might come back and change the rules or get you. So it's a really, you got to really pay attention to the different zoning of each different municipality.
Okay. And I know that, industrial got a lot of attention over the last handful of years, certainly after COVID. And we saw just a huge amount of these, we call them tilt buildings here in Arizona, which are these big, humongous, essentially industrial facilities that are right along the main freeways and logistics transportation hubs. And it sounds like this is very different than that. And it might even be a lot different than these like mini condo units that we see. So industrial has a lot of different facets to it. And this is really just one type of sub market or sub asset class within that. So interesting. Now, is this aspect of industrial getting impacted like a lot of the other larger industrial facilities are, or is this kind of operate on its own with its own kind of dynamics?
The supply and demand story has been consistent for the industrial with outdoor storage assets. So you're not seeing as much of an impact on transaction volume for the outdoor storage properties because there's just such a low supply.
Okay.
At ErvoSquare, we're not owning and investing in these big tilt-up warehouses that you see driving down the highway that are, leased to Amazon or another Fortune 500 company. In
Okay.
addition to the outdoor storage assets, we typically buy small bay industrial properties that are in the lower middle market. So lower middle market, that just means properties that are typically below $15 million in all-in purchase price.
Okay.
So as an example for small bay, imagine a 50,000 square foot building diced up into 10 different units, and each unit is 5,000 square feet. So
Okay.
there's a different tenant profile for those 5,000 square foot suites than the 500,000 building tilt-up building you see going down the highway. Those types of tenants are in the construction industry, and there's mechanics, HVAC companies, steel fabricators, a lot of blue collar trade jobs, and they're less impacted, with the up and downs of the general market. In a
Okay.
market like Denver where they continue to build and there's just expansion, those types of tenants are always going to be looking for space. So that's why we really like small bay and these smaller suites because it's a little bit more less affected by the broader market. There's a deeper tenant pool, and we've had a lot of success with these assets to date.
Okay, and so these are the ones that generally have like maybe one or two offices in the front, and then they've got like a big storage section in the back where they might have a shop or might have storage or might have warehousing, those types of things.
Correct. Yeah, there'll be a
Okay,
small office in front and a couple thousand square feet of shop space in the back. You could either access the building through overhead doors in the front or the back, depending on the configuration of the building. It's just
okay.
nice for these small businesses to have their own independent shop space for them.
Wait, and from what I understand, some of those, like maybe you've got 5 or 10 or 15 of those lined up in a row. Some of those are actually individually owned, and some are owned like just the building, and some are owned by the whole complex. Is that correct?
For sure. So we're typically buying properties that are exclusively for lease, but you
Okay,
are seeing similar type buildings where they condo them out and they sell them out individually.
interesting.
Some people do them for man caves and things like that, where they're
Okay,
parking their luxury and exotic cars, and maybe it's a place to get away from the house. Um,
interesting. Okay,
and sometimes businesses would rather own their small little warehouse suite than lease it. So there are instances of small bay where it's condoed out and sold. And that could also be an exit strategy for a property that we typically
sure.
invest in. You could lease it or you could dice it up and you might get a little bit more of a premium if you sell it out as a smaller
Okay.
condo.
Okay. Yeah. Thank you for walking through that. We don't talk industrial on this podcast all that often. I've always been intrigued with it. Like I said, for 10 years, I met with probably 50% of my clientele were in those type of facilities, and we'd meet in the front, and they were always
Yeah,
so proud to walk me around and tour the facility. Um, it's interesting to hear how those are owned and managed now. So
yeah.
I'm curious
You would
from,
be, sorry to interrupt, but you would be amazed by the different types of businesses that make up the rent roll or make up the buildings we own. You think about it like I never thought about where this type of business is based out of. For instance, there was a company who makes
yeah,
custom poker chips. There's cabinet
right.
makers. There's all sorts of businesses that that use warehouse space, and that's typically our clients.
Well, let's shift if we can. We focus on passive investors. We are passive investors. We're constantly looking for investment opportunities. I suspect that's why we're probably doing our show here today, is just to learn more from an investment standpoint. So,
Yeah.
what do cap rates look like in this space compared to multifamily or office? Are they similar, or are they more advantageous for the investor?
Yeah. So one thing I like about the industrial space that I'm looking at is you're going to have a little bit more of a cap rate premium. I'd say now cap rates are at their peak from what I've seen over the past 3 to 5 years. In my space, I'd say the average in Denver around 7% cap rate, depending on what's the term of the lease and the credit of the tenant. So yeah, we're a little bit higher of a cap rate as opposed to some of that bigger box stuff, which is more focused on lease term and credit. So that's another one of the reasons why we stick with our niche.
And so, do you generally see, like, what's the average? Is it tenancy? Like, how long do these folks stay in these units? Is it? I would imagine it's a little bit higher turnover than you might see with some of these big box stores. Just curious how those compare.
For sure, and that's an advantage of this type of product as well. I'd say average lease term is about 3 years. So there's been a lot of market rent growth over the past couple of years. So these shorter lease terms allow you to reset rents a little bit more frequently than, call it, a 10-year lease. Also, with these shorter lease terms, tenants tend not to expect the landlord to come out of pocket a lot of TI or capital to build out their space. At the end of the day, it's a warehouse, it's a garage. There's only so much you can do. So the shorter term results in a lot of as-is deals. You don't have to come out of pocket to update the space for tenants. So it's a less capital intensive business, which goes along with the shorter lease term, which for us, we feel that kind of protects your downside. These tenants aren't going to say, hey, we're not going to sign this lease unless you cut us a check for $500,000, or our lease comes up for renewal. What are our concessions? It's a lot of as-is deal, and there's a good amount of tenant turnover, but there's not a lot of places for them to go with vacancy below 5%. So we see a lot of tenant retention.
Got it. So it's certainly longer leases than multifamily, maybe not as long as like strip. From an expense standpoint, this isn't like triple net. There are some common area expenses, I would imagine. What does that look like? On the
another thing I love about this asset class is it is triple net. So there are common area expenses, but they're all going to be charged back to the tenants. So what I like about triple net leases is the tenants are paying for taxes, the tenants are paying for an insurance, and all operating costs. So if taxes go through the roof, my bottom line is protected because the tenant's going to be paying for those increases. So that's another reason I really like this asset class, is the lease structure, triple net leases.
Wow. Okay. Yeah, that's interesting. And those are two of the biggest expenses that are impacting most of the commercial real estate space today. That's interesting. So, like, it all sounds like rainbows and unicorns. Everything's perfect, and there's really no drawbacks. Are there areas where this might not be as advantageous as some of the other asset classes out there?
No, I wouldn't say that, but I would say industrial ownership and the investment tends to attract a different type of operator and investor. In the multifamily space, I think there's a lot of competition, especially in the lower end of the market where I'm operating. There's a lot of people trying to invest in that space, mostly because they're just more familiar with it. They're just not familiar with industrial triple net leases, and they've never lived in a warehouse. So we see that as a competitive advantage where there's just more professional operators and investors in the space. It might take an investor, a little reading just to get up to speed on what triple net leases are and what an industrial asset really looks like. But it's really quite simple in my opinion. And it's a good asset class to look into if you're trying to be passive if you're looking for cash flow, all of our investments have a current cash flow component with a back end appreciation. So I think it's a good alternative to the multifamily space.
Okay, and then it sounds like this type of offering, it could be a little more dependent on small business because these are small business owners that are in that space. Probably, I would say probably 0 to 10, maybe 0 to 50 employees. And having been real up close and personal with those types of businesses back in 2008, is this a little more susceptible to the impacts of recession, would you say? Or how do these do historically during times?
I mean, vacancy in the small bay asset class, which I'll again differentiate from the big box tilt top. I mean, it's its own asset class. It's its own animal. And the best thing about these types of assets, if you have 10 suites across the rent roll, you're not just depending on one business. If one tenant goes belly up or leaves, you're still, 90% occupied, and usually downtime and lease up vacancy time is 2 to 3 months. So, historically, there's always been a need for this space, especially when construction costs are so high and it's just too expensive to replicate and rebuild this. It's a lot more cost efficient to build a 500,000 square foot warehouse than a 50,000 square foot warehouse. So, as Denver and similar markets continue to grow, these types of businesses aren't going to go away. They're not building new product, and vacancy is always already pretty low. So, I think that's a good story going forward, and when times get tough.
Yeah, I'm intrigued with this space. I've had some discussions over the years about this. I've looked at it, and for one reason or another, I get distracted and end up back in multifamily and others. But yeah, I'd love to learn more about it. I'm sure the audience would as well. So, what do investment opportunities look like in this space? Are these 506B or 506C opportunities generally, or what type of offerings do you guys have?
Yeah, so we raise capital a variety of ways. We've done private equity deals. We've done partnerships. We've raised syndications for these types of deals, and I think syndications lend themselves to be a great option for these smaller deals. I mean, our average deal size is 5 million or so. So there's a certain type of investor who would be interested in that, and we take pride in being super selective on all of our investments. We've done 2 or 3 per year over the past 3 to 4 years, and we look at a dozen deals a week. So we're hopeful to have some in the pipeline before the end of the year. We're always looking to bring on, more individual investors who want exposure or are interested in the space. So, happy to have those conversations. And if anyone wants to learn more, just reach out. Happy to have a conversation or set up a Zoom call or chat and share some material as to why these are great investments. So no deals no deals that are active at this moment, but that literally could change this afternoon. I'm going on 2 property tours. I'm probably going to put out a couple offers this week. So it's a very fluid business.
Awesome. Very good. And so like the average deal that you're doing that you might make available to investors, what do the return metrics look like? Are these cash flowing from day one? Is there like a year one cash on cash that, might be 5, 6, 7%? And is this your standard kind of 2x equity multiple in 3 to 5 years, or?
Yes. So we're value add investors. So on a deal level, we're trying to double investors' money in 5 years or less. I'm a 2-person company, so you're looking at the investment committee. So we're very nimble, very opportunistic, very flexible. If we have a good offer in year 2 and it makes sense for the investors, well, we can act on that. But 2x equity multiple in 5 years or less. That usually results in a deal level IRR and the high teens getting to 20%. There's a cash on cash component. I'd say mid to high single digits that should increase every year as we increase cash flow and increase NOI and rents. So you might start off at a 5 to 6, and you might end up closer to a 10 towards maturity. That's the strategy. Value add investors. Like you mentioned before, we've bought about 30 million in the past couple of years, and the goal is to aggregate a portfolio of 100 million in the next 2 to 3 years.
Fantastic. Well, you've
That's
done,
the goal.
yeah, you've done amazing things in a very short time, and it seems like these have a tendency to hockey stick, not to tie back into your college days, but
I
yeah.
like
So hopefully, upwards of 100 million plus in the next few years. That sounds great. So. Well, very good, Michael. This has been interesting. I love the space. I love learning more about it. You actually brought a ton of value today. So thank you for walking through those deals. I know at times it sounds like this is just almost an interrogation, but when I find something I'm interested in, like I've got 100 questions I want to ask generally. So thanks for answering those so well and with great detail.
Yeah, for sure. Love to continue the conversation. I mean, I love this. I love what I do. So this is fun talking about it, and excited about this asset class, and I really believe in it. So I love to educate you and any investors or anybody else who wants to learn more about the space.
Awesome. Well, let's if we can. I do have a handful of questions I like to ask before we wrap up the podcast. If you've got just a few more minutes.
Sure thing.
All right. So since this is a fairly new asset class for our listeners and for me as well, are there particular educational resources that you might direct the new or newer passive investor to so they can really get well versed on this space and just even know what type of questions to be asking?
Sure. So I've produced a white paper and an in-depth analysis on the industry and trends and kind of what to look for and the benefits of industrial with outdoor storage and small bay. So reach out. I'm very active on LinkedIn. Just drop me a note and I'm happy to share that white paper with you. But in terms of just, you could educate yourself all you want by reading and listening and watching, but you don't actually learn unless you're doing it, whether investing, setting up calls, touring assets, underwriting deals, chatting with people in the industry. Real estate is really a learn by doing business. So my biggest recommendation for someone getting up to speed on an asset class or who just wants to start investing in real estate is you could talk all you want, but you gotta get out there, you gotta do it, and experience is the best way to actually learn.
That's great advice. We always suggest that as well. Like you can read and listen to podcasts and read white papers, but like the second you write your first check, you become much, much more engaged.
Exactly.
And you learn 10x at that point. So very good.
Yeah.
So I'm curious, what are you doing to kind of stay up with current trends in the space? Are there books and podcasts? Are there organizations or groups that you're staying close to make sure that you're right on the forefront of all the changes in the space?
Yeah, I think the biggest resource is just your human capital network. I literally have multiple calls a day, over a couple dozen calls a week with just peers in the industry, whether they're competitors, lenders, investors, brokers, lawyers. Those are like your real-time data points as to what's happening in this part of town. Why not invest in this jurisdiction, or what did you experience with this lender? So, having those face-to-face, I like face-to-face meetings, and Zoom actually is pretty good here now too, is having those conversations week in and week out and just noticing trends and patterns. I'd say that's my biggest source of learning. So yeah, that's how I stay up to speed. But I'm a real estate guy. I love the business. I'm subscribed to plenty of newsletters and listen to different podcasts and stuff like that. So
Awesome.
So that's how I do it.
And then for the newer passive investor getting started in this space, what would be some due diligence questions that they should be asking if they're newer to this asset class? We all know track record. We all know AUM. We know understanding the business and past history and success, cap rate stuff. But what are some unique due diligence questions for this specific asset class that they should be asking?
How much money are you investing personally? So okay. to the sponsor, I mean, you want interests aligned, right? So if a sponsor doesn't have any money in the deal, you might say, okay, is how aligned are our interests? So I'm personally invested heavily in all my deals. And that's something I say, if you do well, obviously I do well. I'm putting my money where my mouth is. Also, like what's our downside? What's our worst case scenario? If things blow up and go totally wrong, am I losing money?
Mhm.
I do that for all my investments. I present that scenario, and if we're losing money in that downside scenario, I'm not doing the deal. You're looking for something with an asymmetric risk profile where your downside is protected, you have an outsized chance of hitting your upside, and hedging it in some way, shape, or form. So
Yep.
always protecting your downside, knowing your downside, and you can look at your investors in the eye and say, even if things go wrong, I'm not going to lose your money.
Yeah, something that I wish some of the operators I worked with had done as well in years past. I'll just leave that there. Okay.
Yeah.
All right. And then lastly, just a couple of fun questions here. So um, I'm a big fan of bucket list adventures and experiences. And I'm curious, do you have any recent bucket list items you've checked off your list or ones you hope to in the near future?
Yeah. Well, the wife and I just got back from Bali. That's been on our travel bucket list for a while, and we did some great scuba diving there, so that was cool. So, but scuba dive the Great Barrier Reef, that's on a future bucket list item. So that's one of
Yeah.
them. Um, just got married to my beautiful wife Roz about a year ago, so starting a
All
family
right.
is hopefully in the short-term plans.
All
That's on the
right.
bucket list. And we got Olympic fever in Paris, so we're hoping to go when they come to LA
Fantastic. Yeah.
4 years from now.
All right, that's it. Sounds like you're a bucket list guy as well. So those are amazing. Great Barrier Reef is on mine as well, and
Nice.
hoping to do that in the next couple of years. So,
Yeah,
all
that's
right,
awesome.
and then one final question for you before we wrap it up: if you had 100 grand that you had to invest today, but you couldn't put it in your own deal, where would you put that hundred?
It's a good one. Um, being real in real estate, I think the prop tech industry is pretty compelling and pretty interesting. Real estate's been a little bit more of an archaic business and slow to adopt new technologies, so I think there could be opportunities there. For example, I just closed on a refinancing a week or two ago, and there's hundreds of emails back and forth between title and the attorneys. I had to drive all the way across town to go to the title office and hand sign 20, 30 docs, get them notarized. And, it's just a very manual process. So, things
Sure.
like that I think are ripe for disruption. And I just think about technology like the blockchain could be something implemented there to really streamline and improve and strengthen that process. So, I think prop tech could be a pretty interesting play as things start to get adopted in the space.
Interesting. Okay, yeah, I've not had that response yet. So very cool. Well, thank you so much. Though this has been a lot of fun, Michael. Thank you so much for being on the show. I think you brought a ton of value to the audience, and it's been a real pleasure. So thanks for being on the show.
Thanks, Randy. I appreciate it. And anybody want to reach out, I'm very active on LinkedIn. Just look me up, send me a message. Happy to set up a time to talk or chat, set up a Zoom. I really appreciate that. So thanks for your time, Randy, and thanks for having me.
Absolutely. All right, and to the audience, as always, thank you again for joining us today with another great episode. As always, we suggest that you continue your education journey in the space, but more important than that, we encourage you to make the decision to make that first or next passive investment. Both Michael and I are convinced that once you do, you will wish that you had just started that much sooner. So thank you again for joining us today, and be sure to join us next week, next Thursday, for another great episode. Thank you.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.